Only mode.
Good afternoon, everybody. This is Stan and Jack for theartofchart.net, and this is a webinar that we're doing on classical analysis in day trading. And this is part 2 of a multi-part series. And before we get into the multi-part series, just a couple of announcements. Well, first of all, our disclaimer. Everything we do here on the Art of Chart, it's for educational purposes only. So what we're doing here is we're sharing with you technical analysis, how to look at the market, and some training on the markets and trading them, etc. And none of what we do is intended to be any sort of trading recommendation. And so we do this for educational purposes. We hope you benefit from it. And that's the introduction, Jack. In terms of the Art of Chart, the only other thing I want to just announce to everybody, go to the subscriber content tab. The advanced charting package, silver, natural gas, and the bonds, and the euro, the pound, coffee, and sugar. This package we're going to be taking off the website because we have only a few people that actually want it. So if you're a subscriber to that package, and there are only a couple of you, I just want to let you guys know that we're going to be taking that package off, and you'll be getting a refund if you just recently resubscribed or whatever. And I just want you guys to know that. Also, the international package will be coming off. And the reason is, again, because there are only a couple of people interested. So we're going to be focusing our energy, Jack and I, in Chart Chat, the basic chart package, the daily video, and something new called Jack's bonus charts. Now, Jack's bonus charts, just to let everybody see what's on here, we are posting, Jack and I are posting charts here that are 60-minute to 15-minute charts, and they're posted every morning before the open. And what this is intended to be is basically a support to any of you out there who are day trading, because most of what we do on the Art of Chart is related to swing trading, including including the other chart packages and the other work we do. So this is intended to support swing trading, and if you're a subscriber, of course, you get access to that area. That's going to be intended for more the triple play subscribers, and I just wanted everybody to know that that's a new feature. So what we're doing after we've been up and running now for 2 months, and so we're learning, you know, people really want the support that the daily video update provides and that these basic chart packages provide and what the Chart Chat provides. But the other services, we're going to eliminate those, and we're going to focus more on the short-term stuff, which people seem to have a very, very great interest in. So I just wanted to put that out there, Jack, so everybody knows what we're doing. It's right. a bit of a shift, and I think we're ready to start with the outline and get going, yeah?
All right, well.
So I'm going to pass the screen back to you, and let's begin.
Right. Now, can you see my screen all right?
No, I do now.
All right, okay. Now, we were looking at this agenda last week. We've covered some of the elements of this, but I think we ran out of time, and there was, I think really we might actually end up redoing all this as about 6 or 7 different webinars, because each of these points really deserves, you know, quite a lot of attention. But I think we'll what we'll do is we'll cover what we didn't cover last week. We didn't look at RSI and MACD indicators last week, and I think that that needs to be a key focus today. I want to talk a bit more about Fibonacci retracements on trending patterns and what trending patterns are. And I think we really didn't devote any time to head and shoulders and double tops.
I agree with you. I think those are 3 areas, and we could probably cover all 3 in an hour.
Yeah. So I think let's focus on those today. Okay. We may, as I said, we might revisit this later and do a much more detailed look at a number of these things. And to be honest, we could do a full webinar just on how to draw trend lines correctly, because for some reason that seems to be very poorly covered. Now, what I want to talk about initially is RSI. Now, I'm going to go through and annotate on this chart what's been happening the last couple of days, and this is the SPX 1-minute chart, and this is what you could have got from RSI today. So I'm going to go through and explain it as the day went, because this was a remarkable day. It's and there was some very interesting points on it. Now, Also, I'll illustrate some of the trendline work I was using and the conclusions I was drawing from each break. But first, the RSI. Now, one thing you'll notice on my charts is you will see a lot of these lines, they tend to be, they're either red or very light green. Red actually means that they are referencing the RSI 14, and light green means they're referencing the RSI 5. The RSI 5 will give you much more sensitive signals than the RSI 14 will. But in terms of the 1 minute chart, the RSI 14 is mainly what I use. In terms of smaller bounces and so on, I do keep an eye on the RSI 5, which does generate a lot of signals, and a lot of those actually deliver. Now, let's have a quick look. Now, the purpose of these lines is obviously to match up what's happening on RSI with what's happening on price. This is divergences. Only really look at divergences after they've either reached 70 or 30. Divergences halfway through a move and so on, I mean, they're really not that interesting, and they're really not that useful. So if you basically make a rule, the higher the RSI is to start off with, generally speaking, the more useful the signal is likely to be. And there are a couple of exceptions, and because today was a trend day, I can illustrate what a trend day looks like and what to watch out for on RSI on a trend day. Now, hang on, I'm just going to score out the key highs and lows here. You see here, it looks like there was a divergence, but actually there wasn't, because this was a higher high. I mean, as a general rule of thumb, you can bend this rule a little, but it's not advisable to bend it much. Any divergence has to be with, let's say, a higher high on price, which is matched with a lower high on RSI, and at the bottom, obviously, a lower low on price, which is matched by a higher low on RSI. That's what I'm talking about when I'm talking about divergences. I'm not talking about considering whether or not one's just moved a bit more aggressively in the direction than the other. I'm looking for a full divergence, which is that price goes one way, RSI goes the other. Those generate the most useful information, and I'd really stick to that and ignore everything else. As with an awful lot of things, it's best to try and keep it simple where possible, because you really don't. Well, I mean, the added complication adds nothing useful and introduces confusion. Now, let's have. Right, I'm still marking up the RSI 14 divergences, but I'm marking up every instance here where we've made a short-term high, well, basically where there's been a divergence. You'll notice all these mark highs and lows, and I'll show you how I do those too. It's right. Now, the first thing to consider is on a trend day, none of this matters. On a trend day, you can go through any resistance level. You can go any buy or sell signal is likely to get run over. All the normal stuff stops working on a trend day. So one of the first things you need to do is identify what is likely to give you a trend day. Stan very helpfully, I mentioned it on my post this morning, Stan very helpfully identifies the likely trend days and called this one obviously today. I was rather hoping it would go down, but hey, I did mention in my post this morning that you know, these things can always go the other way, and this one obviously very much did that. So now let's have, obviously this is a 2-day chart, so I've included what's happened yesterday, and let's, right here, you need the two. Got here, you've got a lower low here, and you've got a higher low on RSI, and then that spikes up. That is the sign of what will generally be a significant low of some kind. You can find that you get increasing divergence, so you continue making lower lows with higher lows on RSI. That happens sometimes. It's very annoying when it happens, but I mean the reality is that's just the nature of the beast. You have to recognize what you're looking at and work with that. On Right. When you get a break like this, what you're looking for is a hit of the opposite side. You've got the line at the 30 level, and you've got the line at the 70 level. If you're looking at a buy at a buy signal, you're looking for a hit at the 70 level. If you're looking at a sell signal, you're looking for a hit at the 30 level. You'll sometimes see a near miss. I can't actually see any of those on this chart. Normally they'll make the full target. Occasionally they'll come and almost make it, and make it into the, I would say the near miss area is, for a sell signal, would be the 30 to 35 area, and the buy signal would be the 65 to 70 area. You can find that they often come very close, like 68, 69, and not quite hit, and it doesn't come back. Sometimes it will come back, but you've got to really stop disregarding the sell signal at that stage, because it's no longer telling you anything which is giving you a significant edge. Now, so here we've got a variety. We had a buy signal here. This one actually didn't make that, came back and retested. That's fine. It didn't reach the near miss area. It only made it just slightly past 60. So this comes back, retests, making a double bottom there, goes up. You expect that to reach target, and it does. You then get a much smaller divergence here. A smaller divergence is more likely to get run over. It's more likely to have a move that goes against it and then makes a higher high on RSI, which is what kills the existing divergence signal. So this one, however, was fine. A lot of these play out. This one, sell signal, comes down, and it's a hard move, and you make a very low low on RSI. These tend to make extremely good signals. If you have the first high, just looking on here, I already had, oh yeah, okay, yeah, these are the weaker sell signals here, and actually this one didn't deliver. This one didn't make target, and then of course you had the closing spike going up. It's this one here looks very similar. That made target just fine. So it varies. But these were lower probability signals than ones like this. This is very high probability. This is high probability. This was high probability, but we're in the trend move. Now, some of you will have noticed on Twitter that I mentioned that the trend move had finished. Now, obviously, we went on to make a new high, and the reality is you can go and make a new high. But the actual trend day part, as we classify it in the Princeton Trader Room, and as I generally use it, had finished. What was marking out the trend day? Well, one of the key things to look at on RSI is, can it reach 30? If you're on the trend up, then generally it's not going to. It might do maybe for one retracement in the afternoon. Possibly. We've got another indicator which we use, which isn't ours, and I can't talk about, but it hit that as well as coming down and hitting 30 RSI and going well below it here. That was a pretty good signal that the trend day was over. But you've then got, hang on, and this is, I just don't want to confuse you with too much here, but the RSI is a really, really, really useful tool. Let's have a quick look.
Yeah, I don't know how I would ever trade without RSI. It's a momentum indicator, and it's a very useful momentum indicator. And learning to use it is probably, in my opinion, like one of the most important things a trader could do.
It's really useful. And I think one of the webinars,
there's so much you can do with it. There's so many different ways to use it as well.
I think one of the follow-up webinars we're going to do is most definitely going to be just devoted to looking at RSI. We could do 2 or 3 of those probably, actually. Right. In terms of this particular trend here, what have you got? You've got a falling wedge. It has formed a very nice falling wedge. In fact, rather nicer than anything actually that formed on price. That happens a lot. You'll find a lot of the time you're effectively seeing the true move being set up in trend lines on RSI when it isn't fair on price, and you can generally rely on that RSI pattern. So there you go, falling wedge, breaks up. You've got, and this is, again, most people don't look for these, but I noticed a long time ago that, hang on, that you also get reversal patterns. And right here, what have you got? You've got a perfect little inverted head shoulder pattern. It's a beauty. This was actually mirrored by one down on price here. You can have a look. And here is the inverted head and shoulders on the right on the price. So here we get this retracement, we come off trend. This is where I'm talking, but I'm also talking on Twitter about the possibility that we could retest the highs. Retesting the highs is very, very normal. This is one problem with selling a breakout. You can always retest the high. The most common form of topping pattern is not the head and shoulder pattern, it's the double top. It's and there we have
double bottom. Yeah,
and double bottom.
It's cousin, it's cousin the double bottom, right?
as reversal patterns, the double hits are probably 2 or 3 times as common as the head and shoulder patterns, I think. And actually, almost all of the reversal patterns will be one or the other. You will sometimes get some exceptions. I'll talk about those in another webinar. You can sometimes get wedges acting in effect as reversal patterns when they break against the way they would normally break. So you can get, I mean, there are exceptions, there are always exceptions. But generally speaking, when you're looking for a reversal pattern, you're looking at the end of an uptrend, you're looking for a double top or a head and shoulder pattern, and at the end of a downtrend, you're looking for a double bottom or an inverted head and shoulders. Here, we get an inverted head and shoulders. This breaks up here, we're obviously starting a new move up. Now, right, one thing to mention just on trend lines is anchors. When you anchor a trend line, you'll notice I'm generally using less so on the major trend line is the one declining resistance on a downtrend, rising support on an uptrend. These generally require very, very specific anchors. Those anchors will be generally centered on the reversal pattern, of which there will normally be one. On a double top, you will take it from the second high of the double top. On inverted head and shoulders, you will take it generally from the right shoulder, but you can find, although not in this instance, you can find that if the trend is shallow enough, then it's fine to take it from the head. If you can see the head with the trend line, if the trend line would go through the head, then you use the head. Otherwise, you use the shoulder. So here we have a little trending pattern up here, and you can see that this is a wedge. Quite a nice little wedge, actually.
And so, there are a few other things about trending patterns in terms of how they end. Okay, so the wedge is a very classic way that you see RSI. However, there's some other ways where you can see a wedge ending where you have, and it doesn't show there, but and it's probably because it's a 1-minute chart, right? But on higher level charts and also on tick charts, you have divergence, and also there's some patterns that you can pick up also using RSI. So at some point when you finish, Jack, I want to just show the ES chart at a higher level. It shows
sure.
A slightly, well, see, the wedge that you have right there, that's a clear ending pattern right there. Very clear.
Yep. But it wasn't the end.
Yeah,
it's
right.
Because what happened was you then get a divergence here, the move reverses, you've already broken the trend line, that's fairly routine, particularly on a head and shoulder pattern. Well, in this case, I'd be reading this one. No, this is a head and shoulder pattern, actually. Right, you can see it there. I'm just putting in the neckline here, obviously left shoulder, head, right shoulder, and it goes down, and it doesn't make target. What gives you your first indication that there might be a problem? Well, you look on the RSI 5, and on the RSI 5, you get a divergence. It's these little signals are sort of trends within the trends, generally speaking. Here, this was I'd gone long here, I was short here. As it came down, I was then quick to scratch the shorts when this broke up, and then it just continued. So This never made it back to the bottom again. As soon as this made a higher high, I was looking to think, well, you know, is there at that stage, as soon as you're making a higher high, if you've got an RSI which starts, you know, at 70 effectively, rather than considerably above it, then obviously it's far more likely to get invalidated. This effectively has a double top, but really that's invalidation. It's you've got something between the two highs. You must not be below. If you're looking at a sell signal, the best signals will have the trough between the two highs above the 50 level. You shouldn't use any if they're below the 40 level. At that stage, it's not a divergence. I quite often get people saying to me, you know, talking about the divergence between here, let's say, and here. That's not a divergence. This is a trend. That's a trend. This is a trend. These are all short-term trends within larger trends. This is the trend that you're actually looking at and measuring. Whether there's a divergence between here and here is neither here nor there. It means absolutely nothing. So you're always looking at the divergence for the trend you're looking at.
It depends upon the chart you're looking at. Again, this is a 1 minute chart, so if you're day trading, you know, you're trading a trend that could last either the whole day, which is typical in day trading, or it could only last maybe part of the day. So trending on a 1 minute chart versus trending on, say, a 4 hour chart are completely different animals. So it's worth just mentioning that, because, you know, you have a wedge formation, for example, that finishes, right? But then you get your pullback. And on a 1 minute chart, I mean, you can continue higher, you can continue lower. It's harder to tell. Where I think longer term guidance, especially when you're swing trading or even day trading, having a 1 hour chart or a 4 hour chart, so you know the direction of the overall trend, is very useful. So doing what Jack is doing, but doing it across multiple time frames, at least 3, I think is very valuable.
Yep. And actually, if you look at the other charts here, that's another 1 minute chart, so let's scratch that one. It's 3 minutes, 5 minutes, 15 minutes, an hour, daily. Now, for some reason, stock charts don't actually do 4 hours, I don't think. They do 2 hours. I think 4 hour is one of my favorite charts for swing trading, because when it starts to trend, it's more accurate than a 1 hour chart for a longer term trend. And divergences on a 4 hour chart, when you see them, they typically hold up. Where 1 hour divergences and 15 minute divergences can very easily break when you're in the process of trading. Yes. Hang on. Let's have a quick look. Just while you're talking about 4 hour charts, let's look at one I posted this morning. Now, here is the US dollar chart. Now, this actually got blown out by the helpful Mr. Draghi. But I've got here, I was talking about the USD pattern here. And it's broken up from, I mean, the reality is all these you see I'm marking up RSI in a similar way here. It's I'm actually marking these up with a third-party program. I can't actually save these, so I'm only marking up the end part. But obviously this very nice rising wedge here, very nice rising wedge here. Resistance was at 95.6, and after Draghi spoke, obviously it broke up over 96. So I haven't had a look at it working out exactly what's happening here. But if you look, the potential was there. If you look, there is actually a inverted head and shoulders here. It didn't look likely to break up until Draghi was speaking, but after he did, that had a target of, because this is a current target actually, that had a target in the 96.2 area, which was made. I think DX is currently at 96.42. So it obviously made that target. Always look out for these; they're extremely useful. But this was the 1 hour chart. Actually, no, I didn't post a 4 hour chart this morning. But here you've got the break up, you've got the buy signal, and here you can see it's reached the near miss area about 3 times. So I've basically disregarded the signal while noting that it could still make that, which of course it did after Draghi spoke. It's this is potentially changing the trend on DX. Actually, there was a possibility it might actually, the downtrend might finish, and I haven't worked the charts on DX yet, but actually that may be happening here. in which case we're starting an impulse move up. But here, I've marked up the RSI. It's pretty much identical to the way I've marked up the 1 minute chart, the way I marked up the 5 minute chart. The patterns are the same, the RSI is the same. You can use them on any time frame really. That's right. Oh, actually, while we're on it,
so let's layer on top of that, Jack, fibs. So I have a chart with fibs looking at RSI.
All right. Well, if you were to look at, let's say, well, let's take this rising wedge here. This is the rising wedge on the daily chart from the October low. Now, when this broke down, this was likely to either make a fib retracement in the 38 at the 38 level, which is marked here, the 50 or the 61.8, or it was likely to make a full retracement. Now, it actually has failed to do that so far, and I'm starting to wonder if it's going to manage it, because this chart that I posted this morning, it's still in play. It could still turn here. It was a wonderful bear setup this morning, and it was almost a tragedy it got run over.
Jack, well, we have somebody saying, please use cursor to point out where you're referencing.
Right, I'm talking about this ES chart here. I drew this a few days ago, and I posted this. I did this chart for subscribers last night, and I posted it again on the bonus charts this morning. And what I was looking at was this is a rising megaphone from the August low, and I pretty much thought that it wasn't going to reach the obvious resistance level, because the thing is, it was either likely to fall here or go up to the megaphone level, and it appeared to be failing, but obviously it went back up and it touched that and reversed there at the first high of the day. It's now overthrowing it, and it's either going to break up now, possibly evolving into another pattern, or this overthrow is a bearish overthrow, and the next move would be back to megaphone support at 1887. What would that overthrow mean? It would mean that it would be extremely likely that on the next touch of this support trend line, it would break down. Having said that, there are two targets on any bear flag, I always say, and this is because it often reverses at the first one, which is rarely mentioned. And the first one is you just retest the low that this is coming from. Now, that's actually not a lot lower on here. That's in, what, 1830 area? So the other way to consider it is that you take the length of the first move, and I think I've got that on. Right. If you're looking at this as a flag, you'd be talking about this section here forming as a flag from the low, and you would work out the target two ways. The first one is to take the length of the flagpole, which is this. Yeah, and you would take from the high of the flag, you would take the length of that flagpole again as a rough guide of where you would expect to be going. The second one is it just retests the lows, and often it will just retest the lows, make a very marginal new low, or slightly higher low, and then take. It's so if this is a flag, then, and if this is a bearish overthrow, then we could expect a strong reversal here, and then we would go down and break this and retest this low. But this is an ES pattern, so obviously the ES low was lower than the RTH low, because the low was in Globex and not in trading hours. Right, my signal is still brewing here. This was quite a, obviously it didn't fix today and went the other way, but it's still there. It could reverse here, and if it does, this was just an absolutely brutal bear trap today. Before the real move down. Is it going to do that? I don't know. That's I'll be very interested to see whether the 200 DMA holds up tomorrow. If it doesn't, then I'd really be favouring a retest of the highs from here. Anyway, so in terms of the trend lines that were going along with these patterns, obviously you've got a fail signal here. This was basically just telling us that we were trending. So really from here, I was disregarding all sell signals. On a trend day, you disregard all counter trend signals because they don't work. and you can lose an awful lot of money trying to behave as though it was a normal day. How do you do trend lines on a move like this? Well, it's with some difficulty. I found a decent trend line, support trend line on here, which is the right one. It's kind of tricky when the first thing you do is you gap up. It's rare that you can then get a decent trend line out of this low here, which would be the obvious anchor point. But here you can see we get the sell signal here, we get the falling wedge, and we break down. When this broke down, this was likely to run quite a bit further, and it did. And this is where the trend ends. We get a rising wedge up here. You can see that sort of residual rising wedge here, but it is a much better one on RSI than it was on price. You get a sell signal. It comes down here, and a head and shoulders, and it comes down here, and it fails. First signal that is failing is here. It moves up, and it just doesn't come back. All right, here. It's and at that stage, I'm redrawing because this was the initial trend line that broke down, and it's coming down. As soon as that makes a higher high, I redraw the trend line. And this then at that stage is a perfect rising channel. When it breaks down again, we get that little dip before the close. That breaks down. And at this stage, hang on, let's see how that looked. There's a Fibonacci retracement. And there we are. The channel breaks down. It does a perfect, very, very close, 38.2% fib retracement, and that is a classic target on a trending pattern. It also formed, and this is something we haven't really talked about yet, but might do in another session, but it also formed a flag. And a flag is a counter-trend move that is a weak move. It does not retrace a great deal of the preceding trend generally. Well, I mean, it's basically at a much, much slower rate. This is, you're getting your fast move up, you're getting a retracement sideways and down, and that is a classical flag. When that broke up, which it did at the close, then the bears were in significant amounts of trouble, and it went straight up from there. That is how you could pretty accurately map everything that happened this afternoon on an RSI. Not all of it worked, but even when it failed, you could see the signals coming, and you could make adjustments within a reasonable time frame. RSI is possibly the most useful tool in your arsenal, and not nearly enough attention is devoted to it. Anyway, do you want to talk about it for a while, sir?
Well, I have a chart set up talking about fibs and patterns and RSI together.
All right, I'll pass the screen over to you.
Okay. What I have here is a chart showing RSI, and I have trend lines and patterns, and I want to try to put it all together for you because the last webinar we kind of talked about each singular piece, right? So let's talk about fibs and how fibs fit in with RSI. Now, I'm going to start at the bottom here where I have this big yellow box. Why did I draw a yellow box there? Well, look right down here. Do you see the divergence on RSI? Okay, so typically what you're going to find is the market, when it has a strong impulse like this, any strong impulse, you're going to see a divergence in RSI. Okay, now Jack's already talked about divergence, but I want to show you, like, why did I know that this impulse was going to end there? Well, Fibonacci's. So I assume people know how to use extensions. Okay, so if you look from here, there's your A, there's your B, and there's a three-wave move right there to the 100% fib. You can barely see the 100%, but right there it is. It exceeded a little bit. Let me do a larger draw for you so you can see what I'm talking about. So I'm going to do the X to Y. So what I'm trying to share with you is this. It's like when you see a divergence, okay, your odds of it reversing are strong. Okay, in RSI. So this little divergence here, strong chance of it moving the opposite direction, and we had a three-wave move higher. So the three-wave move higher right there to the 100% fib, or in that general area, you can count on a reversal. Now, did RSI help us with that? No, it did not. Okay, RSI does not always diverge. Okay, and it depends upon the type of structure you're in. Okay, but usually at major turns it diverges. By the way, look at where we are right here. and this is ES, folks. So look at that divergence. Okay, so on my stuff right here, this trend line, it's at the top of it, and I'm thinking we turn right here, and we're gonna go down and test the weekly pivot. But that's a different topic of conversation. So I'm starting from the very beginning of this impulse here, and I'm just trying to show you how valuable fibs are. So all this is a 3-wave move to the 100% fib. Now we get a pullback. The thing about trading, and I just want to say this to everybody, pullbacks and back tests are a crapshoot. They really are, okay? Because you don't know where they're going to go. And you could try to measure this 3 waves back. It doesn't measure. Sometimes they measure, sometimes they don't, okay? So I think the lowest probability trade there is counter trend trading, okay? So here we have a divergence. Here we have a possible change in trend, right? 3 waves up. There's a possible trend change, or not trend change. There's a possible reversal there. It comes all the way back, and then we move in the opposite direction and we take out that high. That is a trend change, short term, okay? And so let's look at this next impulse right here, okay, as another example, okay? Again, with fibs, just take your fib extension, and I know this is basic, guys, but some people don't know the basics, so I'm going to do the basics and also some of the advanced stuff in a moment. But here you go again. Look where the 100% fib is, right there. Okay, so the market tends to move in 3 waves. There are exceptions to the rule of 3 waves, but it tends to move in 3 waves. Now, let's say that you have this and you saw the pullback and you got the 3 waves higher and you got this area, okay? Now we have a trend line, okay? Then you do what Jack said, you start drawing trend lines. And so you would draw a trend line, and I'm just trying to use the current pattern just to demonstrate how to do this in a way that, and I'm trying to get the trend line tool to work. And so, we draw a simple trend line like that. Now we have a pattern. Do you see the pattern? We have a possible trend line, and we don't know the other pattern until this gets put in, okay? But what I'm trying to share with you is we have a 3-wave move for a W, there's your X, another 3-wave move to the 100% fib, so you know where the impulse is going to end, okay? You know where it's going to end. And by the way, this blue line here is the monthly pivot. Every trader should have the monthly pivot and the weekly pivot on their chart, okay? And then if you use RSI and if you use fibs, you have a sense of where the market can turn, okay? Here we have a 3-wave move down. That's 100% fib. We can draw 2 trend lines now. We have a pattern. What is that? That's a megaphone, okay? And you could also see this as a expanding diagonal where you have the X wave crossing between W and X, right? So we talked about this, I think, a couple of webinars ago, but when you get this pattern, you get a big thrust, okay? So that's what happened here. Now, let's talk about this divergence, okay? We see this divergence here, okay? First of all, you get this high. Here's the high, right? You get your first divergence right there. You see where my crosshairs are, right? How do you know that that's the top? Well, you don't know. Okay, so you put some on and you try it, and if you get taken out to the upside like you would have right there, you accept it. That's part of trading, right? You do a double divergence. What do? You put some more on. Why? Because it's a highly likely probability that you're going to retrace, and you do. It's not a big retrace, okay? And that's trading. Where this right here, if you put a swing long on here, well, it would have really worked out to be a great trade if you held it, okay? So all divergences are not big moves, but divergences tell you that momentum is waning, even though price is continuing to go higher, and really the easy money is made. Now, whenever you are in an impulse, something that I like to do with RSI, and this is an RSI tool I use a lot, I encourage people to use it, is to draw a simple trend line. If you drew a trend line right here, you would have stayed in that trade a lot longer than if you were just day trading it, for example. So I think trend lines really work well, especially on a weekly basis. Look at a weekly chart and do some trend line analysis like this. You'll see it's absolutely magic, okay? So trend lines work well on RSI to capture, if you will, a trend. Okay, this is a short-term trend to capture divergences, but also to capture patterns. See this little triangle here, right? And these red boxes. So this was a mistake I made where we had the W in, right? So we caught this wave higher. We called the W right there, and it was an accurate call. Now we saw the A, and then we saw the B, and I expected a flat, and a 1, 2, 3, 4, and 5 lower. And price corrects one of two ways. Sometimes it corrects in price, but sometimes it corrects in time. This is a triangle. Now look at RSI with the triangle. It compresses, right? And so you know when it compresses, it's going to thrust, and that's what happened. We had a thrust out of a triangle here. We came back. Usually inside of the triangle is where it retraces to. We called that retrace. Now, again, you can use RSI to predict where you're at in terms of this peak, right? So here is, again, what you do with RSI. Here's the peak, and right there you look at your first divergence, which is right there near the W. Okay, so you could put some on right there at the divergence, and hopefully you track this lower. And by the way, again, a retrace is very difficult to call. And really the better move is always try to play the impulse, the impulsive side of the market, not necessarily the opposite side of the market. So here we are on a pullback, right? Here's your divergence again. That tells you to get back into the trade long. And using fibs again, okay, here's 100% fib, okay? So if you track from the X here, and all I'm going to show you are some basic fib tools here, okay? So there's an extension, an A, B, C. There's your 100% fib. Where did that take you? Up here to 2025, right? And then what we did is we said, okay, look at this move. It looks like this is a fourth wave. This is a fifth wave. And we used the this tool, which is taking a retracement of RSI, and we're looking for one of two areas. And I'll tell you what, let me use the Y to X, because I think it might be easier to see. You take a retracement tool and you look for one of two numbers. You look for the 1.236, and you also look for the 1.618. So what this is a retracement tool. In other words, most people use the fib retracement tool. They use they use 0.618. They use 0.5, they use 0.382. I use it the opposite way. I use the retracement tool beyond 100%. So I'm taking the retracement here of Y to X, and I'm extending it, 1.618. And we're basically in an area where we're going to turn right now, as far as I'm concerned. Okay, so I'm still looking at this impulse as pretty much complete, frankly, right where it's at. Okay, and I base that on fibs, and the main fib I'm looking at right now is this move from the X right here, right? Because an X wave is a connector wave. There's your Y, there's your X, and I have one of two targets, either 618 or 100%. We're right at the 100% fib. So I'm expecting a turn right now. And that's based on basically using RSI, and I'm using RSI to look at divergences, right? We expected a pullback here because of this divergence, right? We did some fib work to predict where would that move actually end, and we use Fibonacci extensions to do, again, a very simple A, B, C to measure the length of the impulse, or we use Fibonacci expansions, and we do this. I'll do it on this one. A W, I'm sorry, let me do that again. A W to X to look at the pullback, and then looking at the extensions that arise from that. So the extensions that arise from that pullback are usually 1.236 or 1.618. Now I would not apply that in this situation necessarily, but you'd be surprised how often it works. Look at where the 1.618 came in right there. Okay, so these two fibs are very key fibs on a pullback. Okay, doing an extension, not a fib extension, but doing a fib retracement and looking at the reverse extensions, 1.236 and 1.618. It's a pretty good tool in general to predict where the next impulse will land. Okay, and you really have to know where to apply it. To be honest, like for example, I would never apply it here. I would never apply it here. When you're near the top of a formation, like you could apply it here, it gives you this one. You can apply it here, it gave you this one a little bit. It extended beyond it, but fibs are very useful for predicting the duration of an impulse. Okay, and I think you can play around with them. Some people use 1.618 a lot. I've gotten away from that because it's not as reliable as using the 3-wave moves, and looking at trend lines and looking at RSI together. So again, RSI, you can use it to trend, you can use it for divergences, you can use it for patterns, okay? And that's what I wanted to walk through, Jack. And by the way, traders, you need to be able to put certain pivots on your charts, okay? Weekly and monthly are key for longer term swing trading, in my opinion. So just wanted to share that with you. Jack, do you have another?
I've got a chart I'd like to show immediately following on from your ES chart there.
Yep. Okay, very good.
To show why we might have got to this area and might turn here.
Okay, and I want to encourage people, there's a questions box. If you have questions as we're going through this, please post them and we will get to them at the end, which, by the way, Jack, we've been going for 45 minutes. So we probably have maybe 5 minutes or so, and then questions.
Okay, no worries. Well, I just want to talk about, in that case, we're going to leave reversal patterns for another day.
Yeah.
So, I mean, let's have, we've been talking about retests. I've been talking about, I talk often about the power of retests and how a retest is, even however good a trend is looking, you can always retest the last high, the last low. It's, you know, you're always looking for the reversal patterns to form. What have we got here? Well, we've got a possible double bottom here. This has got, if we break up, if we break back up here, which we haven't done yet, but we're actually pretty close to now. But if we do break up here, then the target is up in the 2170 area. And I'll give it an alternate target because the first target is actually the retest of this high, 2134, or it gets 2170. However, one other reason could we have for getting up this far? Well, this is one reason I like using multiple time frame charts, and that's because you get the broad view. What's up here? The retest of broken support. And if we turn here, we've got double resistance here. We've got the retest of broken support, and on the daily chart, we have the 200 DMA right there. Now, if we blow through those tomorrow and do a decent close above them, then you know they're gone. Then at that stage, that's a break up. I mean, I think we're not that far from doing it, but we are obviously at a very obvious fail area. You'll often see in a sizable downtrend that you will come back and retest the 200 DMA and then fail. It's you'll also often find on a pattern that it will come back and it will retest. And it will do a fairly exact retest a lot of the time. This is a fairly exact retest. Personally, I thought this was close enough, and we had really, really nice better setup yesterday. But we've come back, we're redoing the full retest, and we're doing the test of the 200 DMA. This is an obvious turn level, and we'll see whether it actually holds. It's so if it doesn't, then you know fairly soon we'd be calling likely retest of the highs, very likely retest of the highs, and probably run a bit further. So, but at the moment, this is still a very possible fail area, and anyone going long tonight may actually seriously regret that tomorrow if it goes the other way.
I would agree with you, absolutely.
Yeah. So anyway,
we have questions, a bunch of questions. Were you finished, by the way? Because I wanted to.
Yeah.
Okay.
I just wanted to point out one last thing. I don't know whether this will play out, but I mean, in terms of the reversal patterns here, you tend to get multiple ones depending on the level of where you've got to. Initially here we had a head and shoulder pattern that played out quite a while ago. What we may be forming now is a head and shoulder pattern with the neck sloping, an upsloping neckline here, and the ideal target being the ideal right shoulder high being 2019. Obviously this is a bit higher than that. That's not unusual. Although you quite often find that the two shoulders will be at the same level, regardless of the neckline slope. So here we have a possible, if we have a hard reversal here, then that should go down a very long way. We'll see. I'm slightly doubtful about managing a really, really serious decline in November, but we'll see. All right, great. Stan, questions then.
Okay, we have questions here. First one from Fred. How to best predict when an impulse is coming versus a retracement? I have an example, if I could show it on the screen here, Jack.
Yep. Sure.
And I think there's something that used to be used years ago called the box method, Fred. You might be familiar with it. So, you know, one way to tell when an impulse is coming, if you look at ABCs, okay, as a simple way of thinking about trading, okay. So here's an A and a B, right? There's your A move, that box, right? There's your B move, okay? Where's the next impulse? Well, there it is, okay? Literally, A equals C when you're thinking about Fibonacci's and when you're thinking about trending, okay? A typically equals C both in time and also in length. Okay, now by the way, it's not precise. It's not always 100%. I like to think of it as between 100% and 1.236. Okay, anything inside of that range for me works. But this is a great way to tell when you're going to have an impulse. So basically, when you see an impulse and then you see a 50% pullback or so, okay, chances are the odds are very, very high, Fred, that you're going to get another impulse. Okay, so, you know, the most consistent trading that I do tends to be trading that is like 2 days, 3 days in length. And you look at a 4-hour chart, you look at a 1-hour chart, and you see here, like for example, you know, you don't catch every move. It's not possible to catch every move as a trader, right? So here, this was, if I remember right, this was a ceiling. We came up, we tested the ceiling. We were looking for it to go through this low, if you remember, right? It didn't. We broke this high. And so what do? You sit back, you watch it. There's your impulse, right? That's clearly an impulse, and I'm sure you would agree, Fred, right? So that's an impulse. You mark it. You wait for the pullback, and then you say, oh, where's the next impulse? It's always the second move that you can catch. Okay, that's one way to tell that an impulse is coming. It's a very basic way, but it works, okay? The other way to tell that an impulse is coming is when you see a completion. And the other way to look for completion is you look for, well, for example, pattern completion. This W, X, Y, X, when you get the overlap, you get the impulse, right? A triangle, you see a triangle. Certain patterns lead to an impulse, a thrust, right? Right now, I would say that we're about to see an impulse lower. Why? For me, this entire impulse is completed. I think this impulse is done. Okay, when you see a completion like here, we had a completion. This really wasn't an impulse, but this followed, okay? So look for completions for impulses, look for triangles for impulses, and look for A's, okay? This A followed by a B. The C is the trade that you want to make, okay? So those are my thoughts on how to best predict when an impulse is coming. Jack, you have a sense of that? Something you want to share?
On the impulse side, well,
Yeah.
I mean, I think on the classical side, it's less well defined. I mean, yeah. But generally speaking, an impulse move will be stronger and faster, and that's what you're looking for. I mean, a flag is a classic retracement move.
Yeah.
You're talking about a shallow channel, which takes a long time, relatively long to develop in terms of the actual distance covered. Right. And actually, a good example of that would be right here. This move up. Yeah.
Yeah, right there. There's your channel, right? And a break up out of that channel, and whoosh, there we go.
Yeah, that's the difference between a retracement move and an impulsive move, generally speaking. So, I mean, you have to bear in mind. I mean, I know it seems complicated, but the reality is the market is complicated. Yeah, you are talking about, if you take that rising wedge pattern shown there, then you will break that down and find a whole load of sub-patterns within those, and all those sub-patterns have sub-patterns within those with little impulsive moves and retracements down to the limit of detection, which is why I can use the 1-minute chart in pretty much the same way I'd use the daily chart in terms of patterns and RSI. It just goes a lot faster and the moves are smaller. So, but the principles remain the same. It's you have to bear in mind that what you're looking at is a complex mathematical structure being formed.
Yeah, right, absolutely. There's a question here about passwords. Brent, the password for the short-term charts that Jack produces, the password is actually in the subscriber area in the comments section. So if you look in the comments section where Jack announces the page I showed, you will find a password there, and that's where I would look. Okay.
Yep.
Fred had a follow-up question. How about the big 10-2 impulse? Fred, the other thing you look for are patterns. So this is an expanding diagonal or a megaphone. Whenever you see a megaphone, it's like A, B, C, D. The E wave of a megaphone is always an impulse like this. Okay, and it's a big move usually. So patterns like triangles lead to impulses, like the big impulse that came out of the dollar move that we talked about last time. So patterns, if you can recognize a pattern, you can predict the coming impulse. Okay, how does your fib work take into account the aftermarket actions? What is your ES fib resistance? Okay, you have to base aftermarket stuff. First of all, you have to look at structure. Okay, structure is everything. Look where we are right here. We're at the end of a trend day, and we're at a trend line. Now, what do you think the odds are that we're going to reverse right here? I think the aftermarket action, the chances to reverse after a trend day with the divergence, with a touch of a trend line, I think they're pretty high. Now, where are we going to? The first support I would say is the previous degree wave 4, which is right here. And I would also, because that's based on structure, that's not based on fibs or retracements or anything like that. It's also based on this being the weekly pivot. I would think the weekly pivot is going to hold up. We're going to get a bounce. Now, the key question is, will the bounce stop there? And will we, let me just change this, just answering the question. You know, when we see the weekly pivot, we're going to bounce. Are we going to stop there and do this? Okay, or are we going to do this and make a new high? And if we do, we're going to all-time highs. Okay, so the answer to your question in terms of aftermarket actions, you have to take into account structure. You have to take into account trend lines. Okay, here's a trend line, aftermarket action. We break that trend line, we're going to go see the weekly pivot. Okay, now there's an alternative here. Some people do this. They take their fib retracements and they go, where's the 50% fib? Sorry, I'm not using the wrong tool. Where's the 50% fib? 50% fib is 32s. We find support at 32s to 26s. We could bounce higher. I don't think that's going to happen because of the structure. Okay, so not everything is an automatic retracement in terms of 32%, 38%, 50%, 61.8. You use those in the structure at the right time, and this is not the place where I would be using that given what I see here. Okay, so I'm just trying to share with you how you use fib work to take into account aftermarket actions. I don't use just fib work. I use trend lines, I use RSI, I use patterns, and I use pivots, and I use floors and ceilings. Okay, so I think as a trader, you got to use all of that into account to take into account market action. There's one other question, and I'm not sure if you could clarify it. How you got the 70.75 fib? Could you clarify what you're talking about?
Was that addressed to me?
I'm not sure who it was addressed to. That's why I'm asking. Did you mention Did you mention 70.75, Jack?
Nope.
Yeah, neither did I.
I mentioned that on RSI. The 70 level on the RSI, which is the typically where you put the start of the overbought section, and the 30 level on RSI is typically the start of the oversold area. But that's not a Fibonacci.
Yeah. Okay. I'm not sure what that question is related to, and the person hasn't posted a response. So I think those are all the questions, Jack.
Right.
On the E-mini chart. Okay. You're talking about this chart, huh? This number here? Well, that's 100% fib, and that fib right there is my violation fib, which is done by this. Okay. Do you see the X here? The X wave is a connector wave. Okay, so you can draw fibs from any X wave. Okay, always. So, we drew this fib here to get to the 100%, right? Okay. This is a pullback. So I have a fib here going from Y to X, and that's the 100% fib. We break that, we're done. We're going to the upside. So that's my, if we extend beyond the 100% of a X, Y to X relationship, beyond the 100%, that's your invalidation. Anything over 2070, and we're going to new highs. So that's why that fib is there on my stuff. Okay, does that answer your question? I think I did. Yeah. Okay, great. Jack, I think that wraps it up for this. Unless you have another chart or something else you want to go over.
No, yes, that's all right.
Okay.
I think I'd like to do reversal patterns in more detail another time.
Well, let's do that next time. I think Fred just had a comment, and Fred always makes great comments. Fred, I appreciate it. In my experience, it seems Globex movements don't obey the same rules as RTH. Yes, of course, because it's very thin. Okay, so when somebody has it in their mind that they want to actually move the market, they can do it. Okay, it seems like ES can grind up if China market rallies or Europe rallying. Do you feel your methods work well in Globex too? They don't for me. I don't day trade Globex. Okay, and I think a lot of people day trade Globex, and it requires a completely different trading system, in my opinion. And I think at some point we might talk about day trading in Globex. But for me, look, if you're paying attention to the larger pattern and if you're paying attention to the larger trend line, I think the overnight action takes care of itself. Okay, and if you're trying to day trade overnight, then you really need a completely different trading system. Well, not completely different. I mean, RSI still applies. You're going to be trading on a 3-minute chart or something like that.
But for long periods, nothing happens on Globex.
Yeah, very thin.
And equally, it's you need to be aware of a number of other things, like for instance, when particular markets open and close, which has a very big impact on the Globex volume.
Yeah.
There's just a number of very specific things to be aware of with Globex trading. But I think it'd be a mistake to think that it was a simple matter. So in terms of do the divergences often deliver and so on and so forth, yes, but less so. They're more likely to get knocked off course.
Yeah. If you're looking at RSI and divergences, the lower the time frame, the less reliable. So a 4-hour divergence is more reliable than a 1-hour divergence, which is more reliable than a 15-minute divergence, which is more reliable than a 5-minute divergence. The lower time frame charts are less reliable, just because it doesn't take as much to break the divergence. So that's just something to be aware of, especially if you're trading Globex. I think that's it. I think that's a wrap, Jack.
Yep.
Okay. Everyone, I appreciate the questions. Great questions. Thank you, everybody, for attending. Jack, great job as always. And we'll see you next week. And we'll do reversal patterns next time. Take care, everybody.
All right.